Yep, loud and clear. Nice to see you.
Yeah, all good, mate, and thanks.
Yep, all good from me, mate.
Yeah, all good. I can hear you.
Sure, happy to jump in. Hi, Adora Lovestrand from Sovereign's Capital. Great to be here. Thank you so much, Anton. We are on Fund 4, and we can talk about how VCs also have to fundraise. So we empathize greatly with everyone listening, thinking about fundraising. What that means is, we're with the companies for 10 years plus. Now on Fund 4, we're still investing seed and Series A software, B2B startups, US and Southeast Asia, particularly. And I would say we're looking at founding teams mostly, and especially in up and coming large markets. AI, obvious one, but always looking at different software trends. But that's me.
Sorry, apologies. Yes, Edward Keelan. I'm a partner over at Octopus Ventures. We're one of the most active VC firms across Europe. My focus is investing from a B2B software fund. It's about $500 million in size. We're doing kind of Series A, B checks, so sort of 2 to 10 million into basically any exciting companies that are changing the way that we work, which with the advent of AI has kind of jet rocketed over the last few years, or certainly over this year. So yeah, we're making about a deal a month, and we're looking across the board, so no sectors specifically. So yeah, love to hear from any founders that are looking to raise at that stage.
Great. I'm Kwaku Akomensa. I'm the commercial director at Grantry. We're a government funding specialist that's been in operation for about the last 15 years now. And we've delivered about $500 million in government-funded, non-dilutive capital to mainly UK tech SMEs. We also partner with a number of VC funds across the UK, both in terms of delivering the IPP, the Investor Partnership Program. So Innovate UK's new fund, which is match funded by VC organizations, but also to support VC portfolio companies and make sure that they've got access to government funding as well as equity-based capital.
My name's Tommy Breen, and I'm a senior advisor at the growth stage. So we are a capital raising platform supporting tech businesses with their fundraise. And as our very on-the-nose name gives away, we are working with businesses that are, already scaling and in that growth stage. So what that means is typically working with businesses raising in and around a Series B round and into much later rounds. So numerically, say maybe companies looking to raise $15 million and above. And outside of that, I'm also a mentor at Founder Institute, so I spend quite a lot of time working with early stage founders as well, trying to guide them through those early stages of the startup journey. Yeah, so the biggest do I would say is, for early stage founders, probably you spend a lot of time looking at LinkedIn and reading media, and you think if you've got a startup, you need to raise venture capital, but it's really important that you understand if you have a business or an idea that is venture backable, and that means going away and doing a bit of research on the idea you have, making sure there is a big enough market opportunity that business could one day be worth, if not $1 billion, certainly well into the hundreds of millions. The reason for that is venture capital funds work off, power law dynamic, where they're investing in a number of companies per portfolio, and basically every company they invest in needs to have the ability to scale to be that size to make up for the ones that won't, make it. So essentially, you need to understand, is your business going to have the opportunity to get that big? And that's a lot of, market research on, who your potential customers are, what competitors are doing. I won't get too deep into it. But, if you do come to the conclusion that your business is not venture backable, it doesn't mean you won't still have a great business. You can have a business that can be worth, millions without that anyway, and you can make a lot of money for yourself, but there's just no point in wasting your time going to investors that are never going to invest. What I would say is, if you go through that process and you determine you do have a business that is venture backable and you go out to investors, make sure you do your homework on those investors and don't go after the wrong ones. So there's no point in going to Octopus, for example, who are maybe looking at, businesses that are changing the way we work. If you've got a completely different business that they've no interest in investing in, or any other investor. So, if you're doing consumer tech, don't go to an exclusively B2B SaaS investor, because they won't even respond to you. So just be really careful that you're going to the right investors, not to waste your own time or theirs.
I think I was next up. My only, I'm not trying to be controversial or anything, but my only thing would be to say, like, if you've got a hint that it might be an investor for you, then don't fear reaching out. As a VC, I've got much more FOMO over missing out on deals that have decided not to come to me because they thought I wasn't right, and then it transpires it would have been. So I'd give it a fairly broad spectrum. My do is be very clear about the problem you're solving for, and why that is interesting for a VC. The problem is probably one that you've lived and breathed as a founder for, I don't know, years and years and years. You understand it completely, but for the investor, it'll be the first time that they're kind of getting to grips with it. And so therefore you've got to really explain it kind of at first principles. Why there's so many times see companies that give us a solution, but we don't really understand what that solution is for or why they've put it together. And then my second bit of feedback would be, and it kind of adds on to what was just said, is don't go straight to your sort of number one VC. So you'll sort of have some VCs which you absolutely think are the ones for you. The mistake is to go there straight away. My advice would be, don't do that. Go to others first that are maybe kind of in your tier 3 or tier 2 list. Get advice from, or get feedback from them. Get as much kind of feedback on your pitch deck, etc., and adjust accordingly. And then when you do go to your tier 1 list, try and do it through an intro. All the data says, rightfully or wrongly, that you get miles more contacts from warm intros. So yeah, my advice on don't go straight to the number one VCs on your list.
Sure. So from my side, in terms of do's, building a narrative and a relationship with the contacts at the VC that you're looking for. So not just popping up out of nowhere with an expectation that rounds are going to close out in 3 to 6 months time. Given that rounds are taking a lot longer, keep in touch. Let them know of the interesting things that are happening in your business. When you bring on board a big client, when you make a big hire, when there's maybe another investor that's come in. Like, keep that narrative building with an investor, because it's a bit more of a marathon these days than a sprint, and a lot of investors like to see that relationship. They like to get to know you a little bit more before making a commitment. In terms of don'ts, I would say avoid really glitzy presentations at the cost of focusing on the actual figures. I think that the due diligence that VCs are doing nowadays is far more based on your core figures than your the dream that you're trying to sell as a business, particularly in the sort of later rounds of investment, certainly post-seed. And then, in that same vein, focusing on clarity. So making sure that you're not using lots of buzzwords or amorphous terminology that's going to confuse people in the room. It needs to be a message that is passable between colleagues at a VC firm and easily understandable to your audience. Thanks.
Yeah, not much to add from everyone else, but I guess with the do's, I'm going to continue what was just said. Before launching the fundraise, we have to have a plan. Obviously, it's going to be a negotiation, and the investors, we have an idea of what we want for the round, and price and valuation, all that stuff. But it's really important for you as CEOs to come with a plan, right? So what kind of capital do you want? Is it priced or convertible? From whom? I think someone mentioned it earlier. Is it from an accelerator, angel, family office, VC? All very different types of investors, different expectations and their own timelines. And then kind of what is enough, like the amount raised, being able to justify why you need 6 million versus 10 million round, the dilution or valuation you're willing to take, and that use of funds is really important. You know, how are you going to use that 6 million, for example? And then lastly, the milestones that you're going to achieve with that money. You coming with that plan actually really, I think, gives a lot of encouragement, and for the investors that you know your stuff, but also that it allows for a more transparent kind of conversation as you talk about the round. I would say to the don't side of things, I think someone already mentioned, you know, don't cold email everyone. Not a good use of your time. Probably one that is something you guys already thought about is the pitch deck, right? I would say the ideal length is maybe 15 slides. An overly long pitch deck, I think, number one, no one, you know, will they actually read through it if it's been said in an email? You know, what's the most important core items to include? And then also you can put your non-core items in the appendix. So there's space, you know, if a question comes up, there's always opportunity. But that pitch deck is such a first impression. If you can do it well, and I'll point you to, like, you know, YC Startup Library. There's some good templates out there and some other resources online. But yeah, that's a first impression. So take your time and don't make it too long of a pitch deck.
This was amazing. I really appreciate all four of you, and thank you very much for those gems. Right, yeah, we are now 44 minutes away from wrapping up. So a quick reminder, this is Startup Fundraising Q&A 141. We've got a stellar panel of investors and fundraising experts. They're going to be here with us until 1 p.m. to take any questions you may have on fundraising in order to take your startup to the next stage. Yeah, it's quite simple. If you're tuning in via our live streams, whether that's LinkedIn, YouTube, Facebook, or Instagram, just remember that we are unable to monitor your questions. So if you've got questions for our stellar panel, you need to join us here on Microsoft Teams. It's audio only, which means you can join from anywhere via any device or platform. Simply go to our site, startuptoscaleup.club. Look for today's session, Startup Fundraising Q&A 141. Click join. It's a quick registration that gets you a link to your email, and then you can join through that. When you're here with us on Microsoft Teams, then simply drop your question in the chat. We'll give you the mic and the floor is yours. In terms of questions today, they can be on anything to do with fundraising, whether that's pitch decks or the right time to start fundraising, or perhaps how much you should ask for, or other stuff about investor outreach, maybe about your pitch deck or certain shares or equity, or the difference between VCs and corporate VCs and angels and crowdfunding, and so on. There literally are no wrong questions, and there's no need to be shy. It's a learning curve for us all. On the other hand, if your questions are on other topics, please save them for the other sessions we run. On Mondays, we help with talent. On Tuesdays, we help with product and tech. On Wednesdays, we help with growth. On Thursdays, as you can see today, we help with fundraising. Second Friday of each month, we get UK startup law. And third Friday of each month, we get UK startup finances. Although this month, we'll do the finances tomorrow. You can RSVP and register to any of those for any of those sessions via our site, startuptoscaleup.club. And when you're there, you might want to join our WhatsApp community. There's a WhatsApp icon at the top and bottom of the page. There's groups of founders, investors, and operators that you can join. Now, we'll go on to our next question. I've put that in the chat. And by the way, panelists, if you don't mind, please feel free to drop your LinkedIn URLs in the chat so that people both tuning in via the live session and those that will go through the recording can reach out to you if you want. You see, we've had 280,000 people join us, and none of that would have been possible without people like these panelists and their other fellow panelists. So the least we can do is at least show them some love and follow them on LinkedIn. But let's go on to our next question. So this is from an AI-driven mental health platform near London. They're pre-seed. And she goes on to say, we're an AI-driven mental health platform raising pre-seed funds using a safe. Okay. Our dilemma is setting a valuation cap that's high enough to protect equity. in later rounds, but still attractive to early investors. Given the typical UK approach to safes, what cap levels should we consider to balance founder control and investor appeal, particularly in the sensitive health tech space? Oh boy, this is probably more for our legal Q&A, but nevertheless, maybe we can put Edward on the spot first, and then Kweku, and then Adora, and then Tommy, please. If we can take about a minute each, I think that might be sufficient. Edward?
Yeah, hopefully you can hear me all right. The internet just dropped
Yes,
on
we
me,
can.
but excellent. Yeah, really tough question, and no good answer, I'm afraid. As a Series A, B investor, this is kind of not my space. But what I would normally say is most investors at that early stage are going to want to sort of end up with a 20% stake. That's sort of my very rule of thumb, and everything can change. So I have not much more than that to say. I do think that the world of AI-driven anything at the moment has obviously a premium to it. That is the kind of the reality of it. But there is an awful lot of competition for funding right now in that AI mental health platform space. So I think you're going to have to be prepared for a bit of dilution.
Here, thank you very much for that. Kweku, what's your thoughts on this?
Yeah, I mean, similar. Without a lot more information, I don't know that there's a specific answer that I can give here. So let me waffle for 30 seconds on my thoughts on this. So I think that the kinds of things that you want to keep in mind are going to be how defensible is your position, how unique is the team that you're bringing to the table, do you have IP that is protected already? And particularly in the healthcare space, what we see with a lot of our clients is the ones who are able to gain slightly higher valuations is they've got some kind of unfair advantage in terms of their access to maybe it's patient data or an NHS trust. They've got some kind of inkling of an inroad into the market that others are going to struggle to get. And that's particularly important in healthcare because partnering with the NHS, partnering with, or rather running clinical trials as well, those are the two kind of massive hurdles that sit in front of healthcare companies. And particularly with AI, if you're looking to roll that out at speed, which presumably is going to be the idea here, you're going to look to scale quickly. Those are two massive hurdles that you would need to overcome. The NHS, certainly in the UK, but also clinical trials wherever you do it. So if you can show your would-be investors that you have not just thought about those two obstacles, but have got a credible way to get through them, then you're likely to secure a higher valuation. But yes, like the previous speaker said, 20% sounds like about the right allocation that that a significant investor would look to get at seed stage. Anything lower than that, and it would be it wouldn't be an attractive investment for a lot of the investors that we certainly rub shoulders with. I hope that's useful.
Thanks, Kweku. Adora?
Yeah, hi. Well, I'm just gonna give a disclaimer. Most of my deals are in the US, so the premium is a little higher. So it might be a higher valuation than you've heard, but I'd point you to Carta. Carta is global and they have really good reports. The last pre-seed report that my team was talking about, maybe early March, I believe the median valuation cap for post-money safes were staying quite steady at 10 million for rounds. So the assumption is you're raising 500K to $1 million USD. So maybe, convert as, but I believe it wouldn't be too far off across the Atlantic here. So yeah, with health tech deals, that's about a good third of our portfolio. We've been seeing that number sounds about right, 10 million on average. If you have the AI element, which I think, my panelists here mentioned, there is you can get a bit of a bump up, right? Like 40%, I think on average is a slightly higher valuation for AI-enabled startups. So it's quite an interesting, time right now. I think for the right investor, having that conversation, like, is what value add they're going to bring. Maybe it's a way to negotiate, right? If they're going to be excellent opening doors for clients and all other things, maybe you can meet them halfway, and vice versa, right? You have a great product that they should meet you halfway. But I point you to Carta for that pre-seed report in case you're looking.
Thanks. Yes, Tom.
Not a whole lot to add to what's already been said, to be honest. I'd just say, similar to what Adoran just said, is I would go and do some, comparables work. So go and look at similar mental health tech companies over the last few years and see what valuations they achieved raising their Series A rounds. And, I'd obviously, discard any wild valuations from 2021, 2022, but look maybe in the 2018 to 2020 and anything in maybe the last couple of years, and look, just kind of see if you can figure out what the sort of medium Series A valuations are, and that should help guide you. But yeah, you just need to do a bit of work and research on it, and hopefully find something that when you propose it to the investors, they're happy with.
Well, thank you very much to all four of you. We'll now move on to the next question. Okay, this is an interesting one. Husband and wife co-founders of organic food delivery platform in Birmingham at seed stage. And then she goes on to say, our organic food delivery service is turned into equity crowdfunding for seed funding. But we want to avoid cap table complications that could deter institutional VCs in our Series A. What provisions for exit and dividend restrictions are commonly used to align crowd investors with future growth and allow flexible exits in UK crowdfunding? Additionally, what UK legal frameworks might support crowdfunding share agreements that are tailored to prevent shareholder disputes over logistics or operational changes as we scale? A couple of quick things before I pass this over to the panel. Number one, on the previous questions, if I were you, I wouldn't worry too much in terms of what valuations you get. You should focus on getting your business to the next stage. Remember, Jeff Bezos, I think, has got about 8 or 10% of his company, and he's not doing too badly. So don't worry about that too much. On this one, sounds like you've done quite a bit of research, but personally, I would keep it as simple as you possibly can. I'm sure, and we're going to go now to the panelists, and we'll start with Kweko, who's from crowdfunding, but I'm sure a lot of the reputable crowdfunding companies will help you with this, so keep it simple. But one thing I see, and I see this in and out almost all the time, is that the ones that are really successful are those that have already found half of the money they need before they've started the campaign. And with this, I'd love to hear from Kweko, then Adora, then Tommy, then Edward, please. If we can keep it to about a minute each, that would be great.
Sure. Yeah. So I guess it's definitely possible to keep the round relatively clean. I mean, some good examples of this would be, the classic would be like Monzo leading with Passion Capital with £1 million into their initial fundraise. They led the round and then took a further £1 million from 1,000 different investors in one of Crowdcube's kind of earliest major campaigns. My understanding is that usually in order to keep the cap table quite clean, they'll issue different types of shares. So, A shares to certain types of institutional investors, B shares to to your ordinary kind of consumer investors. Just one other kind of thought on this as well: the fact that you're a B2C company is definitely a really big tick in the box for crowdfunding. It can be an incredible way of getting effectively a financially viable test group to use to try out your service. The other thing is that your service is very understandable as well. So I've seen that crowdfunding campaigns sometimes don't work as well when you're trying to pitch very complicated B2B propositions that need maybe a little bit more sophistication in terms of the investor. I don't think I have anything else to add on that one. I can't really comment on the legals, I'm afraid.
Yeah, same for me on the legal part. I'm not sure, but I guess there's another session for legal that Anton can point you to. Yeah, I guess with crowdfunding as a VC, classic institutional investor, we're not allergic to it. So if there's any worry that's like it causes, any strife between investors, I think we're all quite familiar. I think a crowd safe is quite popular, and we're all familiar. And for our companies that where we have come alongside a crowdfunding round, actually it's to your advantage to have the VC kind of quote unquote lead. I know that WeFunder likes that as well, and I'm sure the same platforms in the UK. So yeah, I think if you can just keep it clean, like on the cap table is where we get worried, right? Is does it come in as a one line item, or does it like split out? And I think thinking about the cap table would be just how that converts over would be a big one that comes to mind. But honestly, to earlier point, B2C companies, this has worked really well in our portfolio. You're getting power users, you're getting free marketing, all the things that you probably would have paid out of pocket. There's a good combination that comes with crowdfunding to your advantage. But yeah, I don't have a ton to say on this one, but we've had pretty good experiences within our portfolio who have done crowdfunding.
Yeah, not a whole lot to say. I think like the likes of Crowdcube, you're really a taker of their terms for this, and the way they tend to do it is all the investors are bundled into one line. So on your cap table, it just says like Crowdcube, XYZ, and they manage the underlying cap table. So you don't have a messy cap table. And then, in terms of agreements and preventing shareholder disputes over logistic operational changes, like you don't need to worry about that. They're not going to be, unless you're planning to give away half of the business, but they're not going to have any board seat or any voting control. And anytime you want to make a business decision on how you run the business, you don't need to go and get a vote from shareholders, so you don't really need to worry about that either. So go and read the Crowdcube website. They've all the information on there and how they manage the cap table stuff, and it's all kind of done for you. I don't think you need to worry too much about most of this stuff.
Yeah, as I understand it, it's fairly formulaic. So just a few things I'd say. If you are looking at very early stage, in the UK, the companies to look at is Seed Legals, who are pretty good at this very early stage sort of stuff and will have experienced it before. Depending on who the crowdfunding platform is, because not all crowdfunding platforms are created equal. Just things to watch out for are things like using nominees rather than having lists of thousands of shareholders, which would be very difficult. And also sort of prevention over being able to raise future funding, and that sort of stuff is always difficult as well. And just more generally on crowdfunding, I think there is the one thing that people sometimes get tripped up on is that they look at things like Brewdog and see how they did multiple rounds, but actually for most crowdfunding rounds, it's a very hard well to go back to. So unlike a sort of supportive VC investor who might follow on a number of times, it's likely that you're kind of one and done. So be wary of that as well.
Thank you very much to all four of you for that. Quick reminder, I can see my other phone flashing, I'm assuming comments or messages via the live streams. Just remember, we are unable to monitor your questions there live. So please do join us here on Microsoft Teams. It's audio only. And you've got links on all of those live streams on LinkedIn, YouTube, Facebook, and Instagram to join us here directly. But if you can't access those, simply go to our website, startuptoscaleup.club, and look for today's session, which is Startup Fundraising Q&A 141. Click join. It's a quick registration, which gets you a link via email. Then you can join us via that link. Once you're here, it's audio only. You can drop your question in the chat. We'll then give you the mic, and you can ask our panel of investors and fundraising experts any questions related to your fundraising journey. And with that in mind, we'll go on to another question. I'm one of three co-founders of a seed stage online marketplace for sustainable home goods in Bristol. Our sustainable home goods marketplace is raising a seed round from impact-driven angels, and we want to protect our control over the company's ethical mission. Are there particular share classes or restricted voting rights that impact investors are familiar with, which we can use to protect decision-making autonomy? Also, how do we present this structure without deterring angels who may want an active governance role? Well, it depends. Most angels are there to help and don't necessarily want to be in the board, but that again, that depends. I'm only speaking from experience here. But let's see what our experts here have got to say on that. Perhaps, I know you deal mostly with the states, Adora, but if you want to give whatever input you have on this, and then we can go on to Tommy, then Edward, then Kweku, please.
Yeah, happy to throw some first thoughts out. Sounds like you have great angels, so that's already a good start, right? They really care and probably align with your ethical mission. I'd be wary of over, creating too many kind of restrictions and over complicating early in the company. So I would say it's the board probably where most of this is going to sit, and you can decide, right? Like two co-founders, who makes up the board, and that really, I think, in the long run, is how you can protect your decision-making autonomy. Who you decide. I in the early days, maybe if I seed round, maybe a board of 3. The later you go, maybe by Series B or later, I'm sure everyone has different arguments about what's the biggest number for a board, but who you choose, right? This is where your autonomy is. Also, you don't. I think the right angels, maybe you can argue that they can have a board seat, but I feel like as founders, the burden is not on you to please all your investors, and hopefully the right angels and investors that you choose will understand your decision-making process. But I think it would be more on the board side, the governance, and who you decide to join that board is where you can kind of set that culture, and it can scale along with the startup.
Yeah, I think, at this early stage, we've got angels coming in. If you want to have one of them come on the board, if there's a particularly good reason, then that's fine. And just make sure that, you plus someone else is on the board. So, they don't have angel doesn't have voting control. But, I'd also like even 3-person board's probably not bad at this stage, but you don't want any more than that. And there shouldn't be much need for angels to be coming on the board at this stage. I mean, if they're investing and want the business to succeed, if they have doors they can open, whether it be, potential customers or helping you with later funding rounds, they don't need to be in the board to do that. So, I just question why they want a board seat and what control they're trying to get anyway. So I would be wary of that, but I would absolutely try and minimize taking on anyone to the board. So maybe one angel max, I would say, and then make sure there's you plus someone else, so they don't have 50% of the board, or don't have a split board.
Yeah, I'm slightly struggling with the question. So I think the panel make a good point around board being important here, and I've seen certainly large angels quite often want a seat on the board, and they want to keep that seat on the board forevermore, even if they've put in a few thousand today and you raise millions in the future. So yeah, be very wary of that, and you can structure board rights in certain ways. When I look at the kind of the question, which actually doesn't talk about boards, it talks about share classes and restricted voting rights. I mean, ultimately, you're going to end up diluting the business by 10-20%, something like that. So you can still own the vast majority of the shares. So I guess the point around this is more just be very careful about your rights as much as anything, about what you can do around consents and things like that. But at this sort of stage, it would be very unusual to see people not getting voting rights, and I'm not quite sure why you would need that particularly. So yeah, you could for example, you could set up the articles such that the articles include your mission somewhere. So the articles are not just for the interest of the shareholders, but also the interest for the wider community, and then have a provision that says that only a vote of more than 75% of the shareholders can change that, and then you just make sure that that you never lose more than 75% of control, so it can never be changed. But I'm not a lawyer, so it's probably enough for me to say now without getting into trouble.
Thank you very much to all four of you. Really appreciate that. We've got 20 minutes to go. Just a quick reminder, we are unable to monitor your questions live if you're following us via our live streams on LinkedIn, YouTube, Facebook, or Instagram. So if you want to ask our team directly, the panelists here, got a stellar panel on fundraising, so investors and fundraising experts, and we're taking any questions you may have on fundraising for your business. The quickest way to join us here on Microsoft Teams is to go to our site, startuptoscaleup.club. Look for today's session, which is Startup Fundraising Q&A 141. Click join, quick registration, gets you a link to your email, and through that link you can join us. When you're here, you can ask us any questions on fundraising, drop them in the chat, and we'll give you the mic. Now, if your questions today are not on fundraising but on other matters, then save them for the other conversations we host. Monday's talent, Tuesday's product and tech, Wednesday's growth, Thursday's fundraising, second Friday of each month is UK startup law, and third Friday of each month is UK startup finances, although tomorrow, for this month, we're going to have the finances tomorrow, which is the fourth week. They're all from 12 to 1 p.m. UK time. You can register to any of them, any future sessions via our site, startuptoscaleup.club. When you're there, you may also want to join our communities on WhatsApp. There's groups of founders, investors, operators, and all that stuff. There's a WhatsApp icon at the top and bottom of our site. And now I think we can go on to another question. Seems we're a bit popular in Bristol this week. Okay, so this is a cybertech founder in Bristol, pre-seed, PhD in cybersecurity. I'm building a cybersecurity solution for small businesses. Investors are asking for a detailed data room. What key documents and information should I include to ensure I'm prepared for due diligence without overwhelming them? Maybe we can start with Tommy, then Edward, then Kweku, and then Adora, please. Let's try and keep it about a minute each, team.
Yeah, so I'd say like the starting point for this is if you do have revenue already, obviously making sure you've got your P&L and balance sheet, I'm sure it's probably quite small, and cash flow, and then projections, and then you're obviously progressing with this idea because you believe it's a good idea and there's a market for it. So just trying to like put together documents in there that show what you think the market opportunity is, what the projections are, show that you've analyzed the competitors, what sets you apart, what your plans are to gain customers, and how you've the traction you've gotten so far, how you've done that, and why you believe that approach scales. So really, like, it's almost a kind of like a detailed business plan. It's obviously a pre-seed. There's only so much detail you can get into. And I would talk about, obviously, a bit about the technology. I would be careful about, if you've a lot of unique code or something that you think really sets you apart in there, I wouldn't put much detail in there that could be potentially used by investors with some of their existing portfolio companies. I don't think they need huge detail. And the reality of data rooms are, particularly at early stages, every investor you talk to, you're never going to have it right for everyone. People like to see, different investors like to see different things in there. So you are going to get investors that are serious about looking at this come back and ask for more information. So you want to just make sure there's like a really clear business plan on why you believe in this idea yourself. So you're just trying to formalize that for them, and then investors will come back with more questions as you progress. So I wouldn't like stress about trying to answer every possible question that could come. I would just have a good make it easy to digest projections for the business and how you're going to execute.
Thank you very much for that, Edward.
Yeah, I'd agree. It's hard to know how far through you are. I mean, I do think a data room can really save you a lot of time in the future. So it's worth kind of setting up the framework of it quite early on. So for me, in a data room, if you do have any customers, for example, some customer contracts, putting them in there. If you do have, you should have a financial model in there. You can sort of break out different sheets if you've got a data room, so you could have the historics and the forecast in different ones. And then, any technical detail, but not too much, is worth having in the technical side. Or maybe it's Gartner reviews or something like that, where somebody's come and reviewed it, and then obviously you'll have your pitch deck. But then you can also put like a pitch deck maybe with some description in there, so just a little bit more information. Obviously, as you go further down the line, so as you get bigger and bigger, then your data rooms can become quite large, and you could have supplier contracts, and you can have kind of template employment contracts, and all sorts of good stuff. Certainly not something to necessarily shoot over straight away, but good data room software, you can actually just release certain areas of the data room as well to potential investors. But what I would say is that if you do get a good data room set up early, then it will save you a lot of time in the future, and it will save a lot of sending confidential documents you don't necessarily want to back and forth on emails.
Thank you very much. I believe it's Kweku and then Adora.
Yeah, not too much to add, maybe just from the tech side. So occasionally in the work that we do, we'll see some really useful technical documentation in a data room that is then repurposed for grant applications. But in terms of tech, without going into too much detail, you want to talk about your team experience, a development roadmap at a very high level, a scene set in terms of the market baseline for your specific technology, and the competitive landscape as well. It's really important. The only other thing apart from that is current cap table as well.
Thank you very much. Last but not least, Adora, please.
Yeah, not much different from everyone else. We try to make our requests in two sets, just to not burden the founders. So my first request, let's say in the first 1 to 2 weeks for us to decide whether we want to continue the conversation or maybe wait for the next round or pass, would be a pitch deck, cap table, current term sheet, if any, or safe, if any, historical financials as mentioned, the models or projections, and finally that product roadmap. That we feel like that covers a good overview of the company. And then the second request, depending if you're seed or Series A, that can be much longer, right? So customer contracts and corporation docs. We want to see kind of org charts, current investor intros as well. We'd like to meet them, talk to them. So yeah, between that could be a very long list if you're Series A, or maybe slightly shorter if you're on seed or pre-seed. But those first 5 or 6 that I mentioned earlier is probably what will help VCs get to a good overview.
Thank you very much, Adora. And just before I add my input here, Kweku, we received quite a few questions on the best ways to go about crowdfunding. So if you want to start first with that, and then if the others want to add anything, they're welcome to. So if you can think, what are some really important things, and how would you advise people to go about their crowdfunding campaign early stage, that would be great. As far as my input on this, I mean, this was pure gold from the team here. What I'm getting from especially the lawyers that are involved in the deals, the more I speak to them, the more I find out. Sorry, I got cut off for a second. So the more I speak to them about this, the more I find out that their advice is to literally have each and every bit of data that you have about your company, start doing that from day 0, put it in a data room, and then do what Edward suggested. A lot of the data room software today allows you to give access to only certain things. So depending, Adora, for example, the last one, mentioned some brilliant stuff that you need to have depending what stage you are and who you're talking to. So yes, it depends what stage you are and who you're talking to, but you can then give access to certain things, and you can then list, maybe in the data room, you can actually list, all the stuff that you've included there, and some of those details, some may be very thorough and extensive, and you can label it there as such, so that then the investors that you're talking to can decide and request, if they want to, a certain document over another one. And you can do it so that they can see that list or the index, or that they can't see. But personally, I think for them to see the index may be a good idea, unless you have some really confidential stuff that you don't want it on the title. But ideally, I would include literally everything you have, because that will come in so handy in you actually running the business rather than just the investments kind of journey. Again, I know this may be not a view that everyone shares, but for me, the more lawyers I speak to about this, the more I'm convinced that it's a good thing to do. But again, you don't have to then share everything with these investors. And where's Kweku? Yes, Kweku, would you like to give us maybe a couple of minutes MBA on running successful crowdfunding campaigns? And then perhaps if we want to go to Tommy, Adora, and Edward, if they want to add anything to it before we get some parting words from themselves. But unfortunately, Kweku, you are our first proper crowdfunding specialist, and we get crowdfunding questions all the time. So rather than go through each question, I thought it'd be a good idea if I give you the floor for a couple of minutes or so, and then if the others want to add in, of course, more than welcome to. How would you do a successful one? And maybe if you want to tell us if there's major differences between what industry or what stage they are and all that jazz.
Yeah, so I guess, like, first of all, cards on the table. I wouldn't consider myself a crowdfunding specialist, but I certainly have a reasonable amount of knowledge on the topic. We as a company used to partner with Crowdcube. I've also been involved in companies that have delivered crowdfunding campaigns, and hundreds of our clients do it. So I'm not a specialist, but I have a lot of experience in the area. So just in terms of some immediate things to consider. First one is that once your crowdfunding campaign goes live, there'll be a online portal effectively for any prospective investors to ask questions. And that's live and it's public to anyone who visits your crowdfunding page, right? You want to make sure that you're managing that like it's a full-time job, right? This should be the equivalent of being available on the phone to angel investors. So you want to make sure that you're managing that Q&A section really, really proactively, that you never let there be a time when a question lingers in that Q&A, seemingly that you don't have the answer, or that you're trying to hide from any of the answers there. So that's the point number one. The next would be to have tiered offers for investors. So depending on the product that you're selling, or the investment that you're promoting, it's quite nice to have tiers that you can offer to investors. So if you're going to invest £1,000, it might be that you get to come and meet the founders. If you're going to invest £10,000, it might be that you are invited to some form of launch party or a premium service for the investment round, or something like that. Investors like to feel that they are, incentivized to go in with slightly larger tickets, particularly when you're talking about retail investors, shall we say, right? You want to make sure that your video, because most of the platforms do include a crowdfunding video, you want to make sure that's absolutely slick, because it's really the first trailer that any of the prospective investors are going to watch. They're going to get a feel for you as a person or as a team of founders. And a lot of the time, some of the others on the call might disagree with this, but with crowd investing, a lot of this is on the basis of the feel that you're getting of the founders, right? So the first impression is really, really crucial. You want to make sure that you're coming to the table with 30% of the funds pre-committed. That gives some initial boost to the crowdfunding campaign, and usually will secure your spot on the kind of fast growth list on most crowdfunding websites. That's really important, because that gets pushed to all of the regular investors, and they see that you're a company that is moving very quickly through the crowdfunding process. Include customer testimonials if you can. It's always a brilliant idea to show off that you're already making money, if you are, and that there's plenty more potential in the customer base that you are yet to utilize. And then the final one here would be to assume fairly low levels of baseline knowledge from your audience. You don't know who it is that's going to be clicking on your campaign. even less so than when you're going in front of an investor for the first time. It might be a high net worth individual who has a whole portfolio of investments. It could be a doctor that is interested in investing in new healthcare platforms, but has clicked on your business because it popped up on their page. It could be any number of other types of investors. So make sure that you really start from the basics, build the level of understanding before going directly into your pitch. That would be my advice.
Thank you very much, Kwaku. And perhaps next time, if you'd like to join us, we can go into much more detail on your real expertise, which is the ground landscape. Although today we didn't really have questions on that. I think I said Adora, then Tommy, then Edward. I can't remember now which, but Adora, any thoughts from what for you as a VC? What do you like to see from startups that have been through crowdfunding? What would you ideally like to see them having done when they went through that?
Yeah, it's really hard to follow Kwaku on that one because he's given such great practical advice. I would say for us, it's just that they accomplished what they set out to do. It did it, what were the milestones? What was the point of it? And I believe it was Edward who said earlier, it's usually a one and done, right? To go back to crowdfunding, we only have one company in portfolio that is able to go back to that now because they have the continued momentum and that marketing push. So, we agreed as a VC, it's okay to go back because it was a very clear milestone. There's a clear point to it, right? And taking care of them, those early investors, but also how do you take care of your VCs as well? I think just aligning all the interests and knowing why you're doing it. That's as long as there's a good, clear reason, and then we gain comfort for that.
Thank you very much, Adora. I think it was Tommy, wasn't it, or Edward? Either of you fellas.
Sure, yeah. I don't have a whole lot to add, and I'm not an expert, but I think it's been touched on already. Crowdfunding is really an exercise in sales and marketing, and just actually being able to demonstrate to investors how you execute in that campaign is actually, if you've done it well, it's quite a good indicator and showing how you manage the process. Created a sense of urgency and demand to be an investor in the business, and then also on the flip side, after the campaign, how well you're able to execute on that, as in were you able to drive a lot of sales? If a lot of the crowdfunding offers on there, they tend to say if you invest 1,000 you get X discount or benefit, and over 5 grand you get more, and over 10 grand, and how much of those offers and coupons have actually been used by them. So actually trying to be able to demonstrate, I think, will be interesting how the crowdfunding campaign was able to actually drive sales and growth of the business. So it's always really good to show if you were really disciplined through the process and how you measured afterwards the impact of it beyond the capital you raised. I think that would always be interesting because it just shows your ability as a founding team to actually drive sales, to create your own marketing and drive sales and see results out of it. So just being able to demonstrate really succinctly whenever you're going to your next round of investors how you're able to execute through the process and the benefits beyond the capital you got from it.
Thank you very much, Tommy. And last but not least, Edwards, as a VC, what would you like to see?
Yeah, I think it's been covered, to be honest. Just throwing out there, I think we've covered pretty much everything.
Okay, well, how about
similar question?
How about we get some parting words from you, and the others can add whatever they want if they want to before we wrap it up. What do you want to leave us with today?
Yeah, what I would say is to part with that, tenacity and perseverance is probably the most important thing when raising funding, especially at the startup. You talk to loads of people, so much obviously resource online, but the one thing for sure is you're going to have to talk to a lot of investors before you get traction. Having that continued belief in what you're doing is really, really important. And it's one of those ones, the first few that you might meet will just not be interested at all, and eventually something will click with somebody who's just interested in this space if you've done it right. So yeah, tenacity and perseverance is the name of the game in today's market.
Thank you very much, Edward. Adora, do you have any parting words for our audience?
Yeah, I just wish you guys the best of luck. It's not an easy job to fundraise. It's a job on top of your full-time job of running a startup. So yeah, stay strong and definitely be picky. There is capital out there. I think the last count was there's $1.7 billion of dry powder in the US between VC and PE. So, choose some investors that align with you as well, and best of luck.
Thank you very much, Adora. We'll go to Tommy, and then last but not least, Kweku, if you've got any parting words, especially that are grant related, would love to hear on that. Tommy?
Yeah, not a lot to say. Just thanks to those that submitted questions, and then I've got an ask for anyone listening that next week, if you do have questions, to come on live and actually chat, because it's always more enjoyable and engaging for us, and we also can give you better, higher quality answers if we can actually dive a bit deeper into your questions. We understand the business or what you're asking a bit more. So if you can, join us in person.
Absolutely, we don't bite. And the thing is, let's be honest, if you can't be asked to join us here live, and I know people have all sorts of fears and views and whatever it may be, but literally, like Thomas said, it makes for a better conversation, and most importantly, you actually get more help by being here. And let's be honest, no one's going to steal.
And Anton,
sorry, go on.
You do a great job. You're here. Not all of us are here every week, but you're here every week. So I appreciate some weeks you might have stuff on, you can't do it. But, surely if you couldn't join this week, you might be able to find the time on one of the coming Thursdays to join. So it'd be great to hear from people in person.
Good stuff. Thank you very much. And last but not least, Kweku.
Yeah, so just final pieces here. You're gonna get a lot of no's from different angels. Don't let that deter you, and also take the feedback. If you haven't got the money, the next best thing is to get some really useful feedback that gets you a yes from the next angel that you speak to. So make sure that you ask for that feedback, be receptive to it, and yeah, you treat that as part of the process. Just one point in terms of the grant funding landscape, there is at the moment a live competition called the Investor Partnerships Program. It's a match funding campaign from 130 certified investors in the UK, where they're able to get match funding from Innovate UK when they're investing in certain types of startups. It's definitely worth taking a look at. I'll share the link to that competition with Anton after this chat, and it's worth kind of having an explore to see whether any of the investors that you're currently speaking to are on that list and could benefit from match funding when they invest in your business. So yeah, that's all from me. Thank you very much for having me.
That's brilliant. Kweku, if I can ask you, rather than here on the chat, if you want to share it on our LinkedIn live stream, I have tagged you onto that. So in the comments there, because I think that would have a greater reach, because a lot of people tend to go through those live streams way more than they do here on our Microsoft Teams. So if you want to tag that, that would be brilliant. Right, couple of quick things before my parting words. Number one, an exclusive news for everybody here. We've just received news that we are going to be part of the fringe events of London Tech Week. All our sessions, we're finding a way now to have all of them within that week, all our 6 sessions. So please feel free to spread that news and let everybody know. We will give priority to people asking questions who are founders and startups that are attending London Tech Week. So remember that. Number 2, we run 6 regular sessions. Monday's talent, Tuesday's product and tech, Wednesday's growth, Thursday's fundraising. Second Friday of each month, it's UK Startup Law. Third Friday of each month, it's UK Startup Finances. However, this month, that is happening tomorrow. And they're all from 12 to 1 p.m. UK time. You can RSVP to any of them via our site, startuptoscaleup.club. Actually, when you're there, you might also want to join our WhatsApp community. We've got some amazing groups of founders, investors, and operators. You can join top and bottom of our site. You can find those. There's a WhatsApp icon. And as far as my parting words, just remember the startup journey can be both challenging, but also quite enjoyable. So try to have some fun and be kind to yourself and everyone else for that matter too. Otherwise, hopefully you can join us for more of a Startup Finances. Thank you and God bless. Bye-bye for now.